Hello, everyone. Welcome to the bi-monthly series wherein we discuss snippets from our research desk. The topic of this video is drivers of stock returns beyond the obvious by WealthTrust Capital Services. The idea of this video is to discuss what drives the stock price from A to B and what are the drivers and how they come to be in a particular stock price. Now, what our research suggests, so for any stock price to go from, let's say, 100 to 200, there has to be a fundamental driver behind it. Now, in our research, it also comes to light that pace of earnings and earnings growth themselves, along with change in multiples, give rise to the change in stock price, right? Now, ideally, in a long-term scenario, what would happen is if the share price goes up by 10%, 80% of that move is explained by growth in earnings and also change in multiples. Now, the earnings themselves are driven by revenue and margins, whereas change in multiples is a function of perception. Revenue and margins are both a function of the product that you sell or the business that you're in, right? Considering you expand into newer geographies, you go into adjacent product lines, your revenues will always grow. However, if you have an amazing products, you will also command a premium in the market. That is why you will even have a higher margin. When both of these things come together, you get a healthy earnings growth or healthy earnings trajectory in general. The second aspect of this movement in share price is also perception. Now, usually what happens is in the short term, perception is the heavier aspect that drives stock returns. However, in the long run, it's the fundamental earnings that drive stock returns broadly. Perception could be as simple as a business that is expected to be evergreen, is expected to last you. I mean, if you were to buy a piece of that business, would remain in business for the next 100 years. That means the perception is fairly high and the price will also be expensive from a valuation standpoint. In the next section, we'll go over some examples to give you a sense on how to look at this. The first example is Asian Paints, wherein the earnings did the heavy lifting. Over the past 10 years, the stock price has compounded by about 11-12%. Now, if you break it down, much of the growth of that 11-12% is driven by growth in earnings. So we also looked at the PAT over the past 10 years. It has roughly grown by about 10 to 11%. And interestingly, multiples have never expanded for the companies. It used to trade at 40, 50 times earnings 10 years ago. And even today, it trades at the same multiples. Now, interestingly, this is the situation wherein the earnings did the heavy lifting, but there was no multiple expansion. However, ITC is the other example wherein the earnings were healthy, but the multiples derated broadly. Now, in case of ITC, the PAT has grown by about 10 to 12% over the past 10 years. The multiples, on the other hand, have contracted by about 5-6% over the past 10 years. That has impacted the share price, and the share price has grown by about 3 to 4% over the past 10 years. There's also because ITC is in the business of tobacco manufacturing, and tobacco manufacturing is seen as a taboo in India. And while the consumption has also gone down in overall volumes, the growth of business has not been that great in the recent past. And that is also the reason why you see the multiple derate. Lastly, we have got Apar Industries. Now, Apar Industries is in the business of manufacturing overhead cables and electric power lines. Interestingly, the stock is a perfect example of growth in business and also being available at cheap valuations. Now, over the past 10 years, the PAT has grown roughly by about 20-22%. Also, the multiple has grown by about another 20% over the past 10 years. And interestingly, that has led to a 40% increase in share price subsequently. Now, this is also because there have been sectoral tailwinds in the recent past, which has led to the increase in multiples. So, interestingly, over the past, between 2014 and 2023, the stock never crossed the 20 times earnings multiple mark. However, after the new budget announcements and allocation to the power sector, which led to the sectoral tailwinds, the stock re-rated to 40 times earnings broadly. So that is what has played out in APAR Industries. So just to sum it up, a majority of movement in the stock price is attributed to earnings and change in multiples. A company with healthy earnings and low valuation PE multiples is a very good combination to have in your portfolio. And I would like to emphasize on this that poor quality stocks are seldom cheap, as quality of earnings itself is poor. And that is why you will see a lot of businesses available at 5, 6 times earnings. But if the quality of earnings is poor, if they do not have a viable product or are in a declining industries, they are most likely to remain in that price to earnings multiple, and you will never see that expansion. And unfortunately, best companies are also there, which have healthy earnings. But the problem there is the valuations will remain expensive forever. So you need growth to justify much of that valuation uh, premium. Having said that, that wraps up our video for this session. Thank you.